Hello and welcome to another episode of Darwin Investors. So tomorrow morning the CPI report's about to come out, and when I took a look ahead at what these numbers were, what's expected from forecasters, I'm afraid that at least I thought that they were being a little bit too optimistic. And maybe the forecasters are privy to some knowledge about housing data and shelter that I'm not privy to, because that's what's really been keeping the CPI number high, and maybe they know something I don't. And that could also be why the Fed wants to strip out housing data from the PCE core inflation so that they can continue raising rates with impunity. All right, so we're going to have a look at these numbers, and then after we look at these numbers, I'll give you my take on which direction that I believe the market is headed. So let's go ahead and look at these numbers. So the way that I get the inflation forecast is I go over here to Trading Economics and I look up the United States inflation rate. And we can see that last month it was 6% year over year. And this month it's expected to be 5.2% year over year. Although the forecast is 5.3%, what we're really going to have to hit is this number if we don't expect the market to have a pretty bad day. And so how do we get this number 5.2%? Well, first we have to review how we got 6%. So to do that, all you do is you go over here to the St. Louis Fed's Consumer Price Index for all consumers, and you just take this number here, which is 301.648, and you divide it by 1 year ago, which is this number here, which is 284.610, and then that's the 6% that we're at currently. Now, to get us to the consensus forecast of 5.2%, what you would do is you would take the March number here, and that's 287.472, and multiply that by 1.052, and that gets us to 302.42, and then we would divide that number by this number here, and we're seeing that month over month, what they're expecting is a 2.56. They'll round it up to 0.3, and you can see that 0.3 looks reasonable. If we look over here in the past 6 months, you see August was 0.2, September 0.4, October 0.5, and so on and so forth. So they're expecting tomorrow's number to come in at 0.025, which they'll round up to 0.3. And that seems pretty reasonable. The oil prices I know were down in the month of March. They started peaking back up here in April, but for that month they were down. But really what keeps this number high has been this shelter number. And it's because the shelter has been lagging. And shelter is a big deal because shelter makes up 33% of the entire weight of the CPI. So the CPI goes as shelter goes, and right now it's been screaming higher. But I'm thinking what's going to happen is it's going to roll over pretty soon, and maybe that's what the street is forecasting, and that's why the CPI is going to come in kind of weaker tomorrow. But what if it comes in a little bit hot? Let's say it comes in 0.4, and let's say it comes in 0.4 every month for the next, say, 4 months. Well, this is the number that we would get. So if we said that 301.648 times 1.004, let's say it comes in at 0.4 tomorrow, and we divide that number by this number 287.472, we would see that the number tomorrow is going to be 5.35, which I'll call 5.4%. And that's going to be a pretty big disappointment to the market. And we would expect that the market would actually go down on these numbers. But if it came in 5.4% every month through June here, let's see what number we would have come June. So tomorrow's number is going to be for March, even though we're in April, so we'll call it, so this is February, so we're going to be, March would be 301.648 times 1.004, and that's March, times 1.004, that's April, times 1.004, that's May, times 1.004, that's June. And if we divide that by this number here, 294.728, divided by 294.728, then we would have an annual inflation rate of 4. And that's if we went up by zero point 0.4 every single month between now and June, which is a pretty high number. And on an annualized, that would be 4.8%. So even if we go up a pretty good clip between now and June, we're still going to be at 4% inflation. And that 4% inflation rate, us getting there, is important to me because our 2-year treasury is sitting at 4%. So if the inflation rate can dip just below 4%, then that would mean we would have positive real yields. And I think that that's ultimately what the Fed tries to get us to. They just try to get us to where the yield on the treasury note is above that of inflation. And that would be called a real interest rate. And so that makes me believe that the markets can be relatively stable, at least in the near term here. And that's being reflected here in this AAII sentiment survey. When you can see that right now, the week ending the 5th of April, it's 33.3% bullish. Now this scares me a little bit because having it to be this bullish, it means that there's a lot more people out there that can sell, because it had been here at 19 and now it's all the way up to 33, and it done so in about 3 weeks. And so all these people bought shares, and so they could sell it and send this market down quite a bit. But I believe that with the real yield being roughly zero, I think that the market's going to find some footing right here. And I do believe that also means that the Fed will stop hiking up the interest rates the way that they have been. All right, so this has been a pretty short video, especially by my standards. So let's just quickly have a look at the earnings that we have coming up for the rest of this week. And I did so. I went over here to earnings whispers. You can see that on Wednesday, there's not a whole lot going on. We've got really Rent the Runway, Sportsman's Warehouse, LVMH, really nothing on Wednesday. And really, again, nothing of note on Thursday. We've got Delta Airlines. They might report a pretty decent quarter. That's worth keeping an eye on just in case you have other travel stocks, Airbnb or United or Marriott hotels or whatever. But nothing really of note other than Delta on Thursday. On Friday is where I think that the earnings season really kicks off in earnest. And that gives us to JP Morgan, United Health, Citigroup, Wells Fargo, BlackRock, PNC Bank. Wow, look out for that one. But this one's supposedly going to do okay, but that's a regional, so we'll see how that goes. Actually, this is the one I'm probably looking forward to the most this Friday, because I'm just kind of curious what their forecast is going to be. JP Morgan, let's just have a look at this one here. We can see that JP Morgan is expected to come in at $3.44 a share. It's not going to be particularly volatile. They expect it to be anywhere between $124 and $130 after earnings. So they're not expecting a whole lot of that, meaning that the consensus estimate of $3.40 a share, earnings whispers is $3.44, and everybody seems to be about in that ballpark. And what is going to be really interesting to note for these banks is going to be their forecast. How are we having like a credit crisis or credit crunch? Are they going to be able to lend out? Are there going to be a lot of write-offs? Are they expecting that people aren't going to be able to pay back their bills and things of that nature? So people might actually look at these bank forecasts and kind of look at it as like a window to a possible recession or like a huge slowdown in the economy, especially in the case of PNC, because they would be more of your small business type of lender. What else is on the calendar here? We also had Wells Fargo. Wells Fargo is expected to do okay. Citigroup, United Health. Citigroup is expected to do kind of poorly on Friday. Wells Fargo is expected to do okay, not as good as JP Morgan. PNC Bank is expected to do really well. Let's have a look at that one. That might be an interesting one. So PNC Bank is expected to get $3.60 a share. It's fallen off of a cliff here. Let's look at their price to earnings ratio and what they're trading at and is it a fair value. So PNC Bank is trading right now at $122. It was trading at about $167 prior to the regional bank collapses that we've had here recently. It's down 23.33% for the year, but maybe that's kind of unfair for them. Let's see. They're trading at a very reasonable price to earnings ratio. They are expecting growth. The industry standard, I think, for financials is roughly 10, and they're trading at 8. They have very nice dividend yield of 4.91%. They have a profit margin of 28.94 and a growth forecast of 11. So PNC actually looks like a pretty good company that you might be able to get on a bit of a discount right now, at least up until the time that they report earnings on Friday. All right, so I just decided to just release a quick video since I noticed that the inflation read was coming out tomorrow, and I was kind of like a little bit pessimistic, I guess, on the consensus forecast. And so if the market starts to come down a lot tomorrow, I'm just trying to say, don't panic. It's going to be okay. I think that the market itself is on decent footing with the interest rates and the inflation rate going to be about, making the real interest rate about zero. All right, so if you got anything out of this video, or if you just want to be more irresistible to women, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a good day. Bye.